Singapore's financial district, a world of immense opportunity and catastrophic hidden risk. In 1995, one man destroyed a 233-year-old bank. Not a war, not a recession. One trader, his name was Leeson. Barings Bank was founded in 1762. It financed governments, it survived wars, it survived the Great Depression. For over 2 centuries, it stood strong, until one internal mistake. Leeson was sent to Singapore to trade derivatives. He was young, confident, ambitious. At first, he made profits, large profits. And profits create trust. Trust reduces supervision. The market, which had been his personal ATM, finally turned against him. A series of futures contracts on the Nikkei 225 index, a bet that the Japanese market would remain stable, suddenly soured. Then came a losing trade. It wasn't a black swan event, not yet. It was the kind of market fluctuation that seasoned traders encounter regularly, a statistical inevitability in the high-stakes game of derivatives. The initial deficit was around £2 million. For a trader who had generated tens of millions in profits, the loss was, on paper, entirely manageable. It was well within the theoretical risk parameters of a major financial institution. Any other trader would have simply booked the loss, taken the hit, and moved on. It was a cost of doing business, a rounding error in the grand scheme of a global bank's balance sheet. But Leeson wasn't just any other trader. He was the star, the miracle worker of the Singapore office. His identity and authority were built on an unbroken record of success. Reporting a loss, even a small one, felt like admitting a crack in the facade. It would invite questions, scrutiny, and a potential blemish on his perfect track record. The culture at Barings, like many banks of the era, prized performance above all else. Oversight was often a distant second. Admitting failure wasn't just a financial transaction, it was a career-defining moment. And in his mind, it was a moment to be avoided at all costs. Reporting it would damage his reputation, so he hid it. This is where the story shifts from a simple trading loss to a catastrophic failure of internal controls. Leeson had a unique and dangerous level of authority. He was not only executing trades on the front office systems, but also settling them in the back office. This dual role violated one of the most fundamental principles of banking, the segregation of duties. This principle exists specifically to prevent a single individual from executing a transaction and then marking their own homework, hiding losses, or fabricating gains. He used this power to create a secret ledger, a place where his mistakes could be tucked away, invisible to the risk managers and auditors in London. He opened a new client account, giving it a number that would become infamous in financial history, account number 888. The number 8 is considered lucky in Chinese culture, a symbol of prosperity. For Leeson, this account was meant to be a temporary holding pen for bad luck, a place where losses could be parked until his Midas touch returned. He wasn't planning to defraud the bank. In his mind, this was a short-term solution. The market would surely turn. He would make a few winning trades, erase the small deficit in the 888 account, and close it down. No one would ever know. It was a rationalization born of arrogance and pressure. He believed he could recover it. He believed he was bigger than the market. In the pre-dawn hours of January 17, 1995, a catastrophic event unfolded nearly 3,000 miles away from Leeson's trading desk in Singapore. The Great Hanshin earthquake, more commonly known as the Kobe earthquake, struck one of Japan's most vital industrial and shipping hubs. It was a black swan event, a complete outlier, unforeseen, and with consequences that would ripple across the globe. For most of the world, it was a human tragedy. For the financial markets, and specifically for Leeson, it was the trigger for a cataclysm of a different kind. Leeson had built his entire strategy on a single, unwavering belief: that the Japanese Nikkei 225 index would remain stable or rise. He had sold a massive number of options, essentially betting that the market wouldn't make any large, sudden moves. This strategy, known as a short straddle, profits from low volatility. But the earthquake was about to unleash the very volatility he was betting against. When the Tokyo Stock Exchange opened, the reaction was immediate and brutal. The Nikkei plummeted. The logic was simple. A key part of Japan's economy had been shattered, and the cost of rebuilding would be astronomical. Confidence evaporated. For Leeson, this was the nightmare scenario. His positions were designed to profit from stability, but the market was now in freefall. Every point the Nikkei dropped was a direct hit to his bottom line. The short options he had sold were now deep in the money for the buyers, meaning his liabilities were exploding exponentially. His positions, a complex web of futures and options, began to move violently in the wrong direction. The sophisticated risk metrics that should have served as a warning system were now screaming red. The Greeks, the variables used to measure an option's risk, like delta and gamma, were turning against him. His negative gamma exposure meant that as the market fell, his losses accelerated at an ever-increasing rate. He was hemorrhaging money faster than he could possibly react. In a desperate attempt to stop the bleeding and single-handedly prop up the market, he did the unthinkable. He started buying Nikkei futures contracts on a massive scale, trying to force the index back up. It was like trying to stop a tsunami with a bucket, but the selling pressure was relentless. The market was a one-way street, and he was standing in the middle of the highway. As he bought, others sold, and the market continued its descent. His frantic buying only served to burn through more of Barings' cash. The losses grew, spiraling from millions into tens of millions, then hundreds of millions. This is where the breakdown of internal controls became fatal. A robust risk management framework would have had hard limits known as value at risk or VAR limits, which would have automatically liquidated his positions once losses reached a certain threshold. Furthermore, the principle of segregation of duties, where one person places trades and another settles them, was completely absent. Leeson controlled both, allowing him to hide the true scale of the disaster in his infamous 8888 error account. By the end of the week, the number was incomprehensible. The losses had ballooned to over £827 million, equivalent to 1.4 billion US dollars. This wasn't just a bad trading loss, it was an existential blow. The sum was more than the bank's entire trading capital and reserves combined. A single trader, operating with virtually no oversight, had gambled away a 233-year-old financial institution. The cultural incentives that prize stellar performance above rigorous oversight had created the perfect environment for disaster. Leeson was a star trader, and as long as he appeared to be making money, no one in London asked the hard questions. The Kobe earthquake didn't bankrupt Barings, it merely exposed the fact that the bank was already functionally insolvent, hollowed out from the inside by a complete and systemic failure of risk control. Executives did not detect the scale in time. Why? Because previous profits had created confidence. High performance reduced oversight, and oversight is what prevents collapse. Barings Bank collapsed, sold for £1. 2 centuries erased, not by markets, by hidden risk. This pattern repeats. It's a story that echoes through the halls of finance, from the tulip mania of the 17th century to the complex derivatives of the 21st. The names change, the markets evolve, but the fundamental human elements at the core of catastrophic failure remain stubbornly consistent. It begins not with malice, but with ambition. A trader, a manager, a firm achieves a string of successes. Profits climb, and with them a dangerous sense of infallibility begins to take root. This is the first, most insidious stage, where the seeds of disaster are sown in the fertile ground of achievement. The narrative of the star trader, or the unbeatable fund, is a powerful one, both internally and externally. It builds a mythos that can become incredibly difficult to question, especially when the numbers seem to prove it true. Ego. Success, especially in the high-stakes world of trading, is a potent drug. It can warp perspective, transforming healthy confidence into hubris. The trader starts to believe their success is a product of unique genius, not market conditions or even luck. They see themselves as separate from the rules that govern others. This is where the first small deviations occur: a position held a little too long, a risk limit nudged just for a day. They are small transgressions, easily rationalized. When the first unexpected loss inevitably arrives, the ego cannot accept it. It's not a failure of their strategy, it's a temporary market anomaly. Reporting the loss would be an admission of fallibility, a crack in the armor of the star performer. So the decision is made not to report it, but to win it back. Escalation. This is the point of no return. The initial, often small, loss must be recouped. The trader doubles down, taking on a larger, riskier position to erase the first deficit and return to profitability. This is the classic escalation of commitment. If that second bet also fails, the hole is now significantly deeper. The pressure intensifies. The secrecy becomes paramount. This is where the breakdown of internal controls becomes an active strategy for the rogue employee. They begin to exploit systemic weaknesses they may have discovered long ago. The ability to influence settlement operations, to park losses in obscure error accounts, to override automated checks. Each successive bet becomes more desperate, a frantic attempt to climb out of a hole they are only digging deeper. Complacency. While one individual is locked in a spiral of concealment and risk, the organization around them is often lulled into a state of complacency. The profits, which for a time may still appear robust, create a powerful disincentive to scrutinize the source. Management sees a high performer and rewards them. The back office, responsible for reconciliation and oversight, may raise flags, but their warnings are often ignored or explained away by the star trader, who has the ear and trust of senior leadership. This is a catastrophic failure of a core risk management principle: the segregation of duties. When the person generating profits is also able to control or influence the reporting and settlement of their own trades, the checks and balances essential for a healthy system are rendered meaningless. Different tools, same behavior. Whether it's unauthorized speculation in copper futures in the 1990s or the mismarking of complex credit default swaps in the 2000s, the underlying behavior is identical. When success increases, supervision must increase. This is the paradox of risk management. The moment a trader or a division starts generating exceptional returns is precisely the moment for the most intense scrutiny, not the least. When losses are hidden, they multiply. They fester in the dark corners of the balance sheet, in unaudited accounts and delayed settlements, growing exponentially. Strong systems collapse quietly first. The foundations erode long before any tremors are felt. The ignored warnings, the overridden controls, the cultural worship of profit over process, these are the silent cracks. Then, suddenly, when history repeats, it begins small.